เซสชันนี้เราจะนำเสนอการลงทุนในตราสารหนี้นะครับโดยเฉพาะตราสารหนี้ประเภท High Yield นะครับซึ่งปีที่ผ่านมาก็ถือว่าเป็นตลาดที่ให้ผลตอบแทนที่ค่อนข้างดีนะครับถ้ามาดู High Yield Index ของอเมริกาในปีที่แล้วเนี่ยก็ให้ผลตอบแทนอยู่ประมาณ 13% นะครับก็ถือว่าเป็นตลาดที่ค่อนข้างน่าสนใจนะครับสำหรับแนวโน้มต่อจากนี้จะเป็นอย่างไรนะครับเรามารับฟังมุมมองจากทางมิสเอกแคทเธอรีนาวีโกสนะครับ CIO Core Investment Asia ex Japan AXA Investment Manager นะครับ Please give a warm welcome to Miss Ekaterina. Over to you.
Well, I think you had an interesting and fruitful, hopefully, morning going through various aspects, whatever that's asset classes or macroeconomics. I would say we are interesting investors at a very interesting crossroads at the moment. We've had two relatively difficult years with regards to macroeconomics, quite a lot of volatility, largely driven by expectations of rates or the tightening, relentless tightening of monetary policy across developed markets but also emerging markets, which has created a lot of uncertainty with regards to deployment into risk and investing into asset classes. As we move into 2024, certainly the big question for investors is, do I allocate now? Do I chase some of the rally that we've seen into the year end of 2023? Do I chase the rally that we've seen already since the beginning of the year? And certainly, which asset classes are expected to have positive returns by the year end? As I said in an earlier session on the macroeconomic environment has turned to be a lot more conducive to risk assets. We've seen the expectations of recessionary risk being priced to more of a soft landing across the board, which certainly provides a positive catalyst with regards to sentiment for investors deploying back into risk. That certainly doesn't give a full canvas or a perfect investing market for risk assets, and certainly there are risks in the economy, and there's certainly risks for individual asset classes. And the big question is, which asset classes will end 2024 in positive territory? And we do think that high yield is well placed to deliver positive returns for 2024. And we're going to dive into some of the dynamics in a high yield market. In terms of the key advantages, and I think possibly the audience here doesn't know all the details, or potentially not fully aware of all the details of the high yield market, so I'll start with the broad overview in terms of what is the high yield market, what are the key advantages, what are the key dynamics. So certainly one of the main attractions and the benefits for high yield is the high compounding income over time. So if you look at the performance of the high yield market over time, and particularly for 2024, largely high yield has stayed in positive territory. If you look at performance of credit, which is the IG investment grade credit, that has actually seen a repricing or adjustment in terms of returns, largely driven by rates. So certainly the relation of high yield to more compounding income and less being related to rates and more being equivalent or closer to equity performance has led to high yield being quite resilient in 2024, despite the fact that we've seen a significant repricing of rate expectations in developed markets, particularly rate expectations for the Fed. Now, upside potential and recovery phase, and this is something that is quite important, as many participants earlier said we've seen in the sessions in a macro environment. We do expect the second part of the year to see a recovery phase in global economies, particularly in places like US, with expectations that Fed and the central banks will reverse their monetary policy. So what does it mean is that the Fed will start cutting rates, the funding available for corporates will start becoming again affordable and cheaper, and we'll see a broader recovery in investment, a broader recovery in R&D for companies, and certainly the potential for growth for companies in 2024 is certainly going to be brighter, which again, the high yield exposure to that upside potential in the second part of the year is quite relevant. Generally less volatile than equities, and I'll also show you a chart later. I think the big misconception about high yield is that it's a high risk asset. Yes, relative to fixed income. So if you compare high yield to its own peers like rates or investment grade corporates, that is deemed to be more risky because obviously the high yield stays lower in a capital structure for companies. but it's less volatile than equities. So high yield is more comparable to equities than it is to fixed income. But in terms of volatility, it's a less volatile asset class. And the reason it's less volatile is because of that higher income potential, or the coupon that you're earning from high yield, which provides a buffer against the volatility for the asset class. And then above equity in terms of capital structure. So despite the fact that the volatility is lower, it does have, it sits higher in capital structure, i.e. in terms of compensation in case of a default, high yield stays above the equity capital structure. So certainly, when you look the asset class in composite, yes, it's riskier relative to other fixed income asset classes, but it's not as risky when you look and compare to higher octane asset classes like equities. Now, in terms of high yield performance, when you look at performance over time, and this again takes the performance of high yield since 1997, the majority of that return is derived by income return. And as I say, compounding income over time is the key advantage of high yield. Something where investors are allowed to harness high income potential from the asset class. Of course, accounting for potential risks, if there's a deterioration of macroeconomic environment, that income can deteriorate, and we've seen that in 2022 and 2021, or deterioration of the macroeconomic environment has led to a higher risk, and certainly the income return from the income return was eroded. But we have to account for the fact that income the last 2 years was much lower. So income generation, or the yield available for high yield at the moment, is around 8%. It was as high as 12% just in 2023. But certainly the 2022, where we've seen negative returns in asset class, we're starting from a much lower income. So the cushion that high yield has generated, or the income protection that you had from high yield, was much lower than we have at the moment. So certainly the income is expected to generate majority of return going forward, and certainly provide sufficient cushion for 2024, sufficient protection for 2024 for investors to be or to stay in that positive territory for the asset class. In terms of, again, talking about high yield, is generally less volatile than equity. Certainly the chart here shows you the performance of various asset classes over time. Again, we take it here from as of 2022, and you can see that certainly high yield places itself quite well relative to equities. So again, a risky asset class in a spectrum of fixed income, but certainly relative to equity is a much less volatile, and certainly the income potential for high yield is undeniably an attractive point for the asset class. Now, compared to fixed income, and say where this is in the spectrum for fixed income, and this compares the performance or the outperformance of the high yield versus U.S. Treasuries versus loans and versus U.S. corporates. And as I mentioned earlier, in the spectrum of fixed income, high yield is riskier, sits lower in a capital structure, but the income generation, or the income you're generating from high yield, is much higher, and certainly the income, compounding income that is generated over the years, gives a superior return for high yield versus other asset classes in fixed income. So I'd say if you had to compare high yield, it sits higher in terms of risk spectrum versus fixed income asset classes, but certainly in compounding returns are much more attractive. When it looks at equity, the volatility of high yield is much lower relative to the equity asset class. Now, if we look at some of the risks and what are the dynamics to expect for 2024, we've talked in the macro session that by and large, the central banks globally are expected to start easing the monetary policy after 2 years of relentless tightening in financial conditions. So across the board, across developed markets and emerging markets, central banks are in a position to start normalizing monetary policy. And again, the reason I want to say normalizing, because this is quite important for something like a high yield asset class. The central banks currently, as a central scenario, are expected to adjust their monetary conditions to easing versus tightening, but not cut rates significantly, which is more compared or is more relevant for a recessionary environment. So it is quite important to reiterate here that we don't expect a recession in the US, and this is quite important for an asset class like high yield. where the central banks will start normalizing monetary policy, not aggressively cutting, which is a big difference. I say normalization is just bringing the current yield environment to be in line with the current growth, which is a bit more subdued, but not aggressively cutting to save the economy, which is a big difference, and I think it's quite an important element to consider for the high yield. If we were in a scenario where central banks are starting to cut rates because the economy is slowing down too quickly and it's recessionary, that's a risk for high yield asset class. So the central scenario of, if you might call it soft landing, or at least decelerating growth but not recessionary growth, it is a positive environment for high yield, where the ability for investors to harness the income, to harness that yield that I've talked about, is very much present for 2024. Now the big question is, what about the risks from spreads? So when you look at the performance of the high yield, obviously the dynamics, macro dynamics play an element, again, less sensitive to the dynamics around rates per se, but rates are very much related to the cycle that we're in. And as I said, the cycle is decelerating growth but not recessionary, is positive. Now in regards to spreads, many clients said, well, the spreads are quite tight, and also there is a risk of refinancing. So what does it mean is that companies in a high yield universe are potentially susceptible to higher funding costs, and that will put pressure on their current balance sheets. Now the element to highlight here for high yield is that the maturity wall, and this compares the maturity, when I say maturity wall, is how many bonds are maturing in 2024, how many bonds are maturing in 2025. So if you look at the maturity wall, or how many bonds are maturing each year from 2024 onwards, certainly that is increasing, but it's less significant than investment grade. So companies do have to refinance in 2024 and 2025, but it's not significant, it's not as significant or not as elevated as it is for investment grade. Another element to consider is that many companies in high yield have chosen other avenues to refinance. So if you look at the issuance in 2023 and the issuing expectations for 2024, those are still expected to be subdued, i.e. there's not many companies away from a general refinancing are coming to the market. So there's less M&A activity, there's less leveraged buyouts, so companies have preserved or preserving their cash not to have to need to come to refinance in a higher funding cost. So many companies have rationalized their balance sheet to use the cash in much more efficient manner and use it more for operational purposes rather than shareholder-friendly activity. Also, what we've seen companies using other channels to refinance. So they've used places like loan markets, they've used private credit markets, they also used equity markets, and we've also seen companies selling some of their assets to generate cash flows or generate cash. So rationalization of the balance sheet has been one of the elements that has pushed that maturity wall or the need for companies to refinance to a much later stage. And also what we observe is that many companies are delaying that maturity wall or delaying to pre-fund because on expectations of the Fed to start easing the monetary policy. So all in all, if you look at the macro environment, it's conducive to harnessing that income. The general health of the corporates and refinancing needs are still relatively subdued and well in control, which allows the investors to benefit from that high income without significant erosion of that income potential. Now looking at a few other things related to the corporate health, so the main aspect, as I said, when it comes to high yield, is the ability for you to harness that income. So if you have at the moment 8% yield that the high yield is generating, the big question is will that 8% be at the end of the year, will that get deteriorated? So the risk of deterioration comes from the fact that you will have a deteriorating growth environment, which as I talked about is not a central case scenario. If we see a company starting to leverage aggressively, that will put pressure on their balance sheet because the funding costs are much higher now. Now, the leverage, as I said earlier, is still very much subdued, and companies have rationalized the leverage on the balance sheet. So the leverage has not increased, and in fact, if you look at the leverage over time or relatively compared to history, it's very subdued. So companies have not levered up yet on the balance sheet, keeping that conservative approach to balance sheet until we have a reversal in the cycle for the monetary policy. So again, the susceptibility of companies to risk of default or risk of weakness on the balance sheet is less pronounced because of that smart management of the balance sheet. Then when you look at high yield coverage ratios, so coverage ratio is what is the ability of companies' cash flow, or how well can their cash flow cover their current interest that they are subject to through their liabilities. So certainly the interest coverage has slightly deteriorated from 2022, but is still very much in a healthy territory. So what does it mean is companies are well placed to service that debt. Now, what does it mean for you as an investor is that if companies are well placed to service the debt, it means there will be less defaults, less downward pressure on the spreads, so the ability for you to harness that 8% is certainly in a better position. So a combination of macro environment being conducive to subdued growth, but still not recessionary, companies are still able to generate cash flows and somewhat the ability for them to control the leverage and cover the interest expenses in a very healthy way preserves the ability for you to generate that 8% without significant erosion into the year end. Now, what does it mean in some of the measures related to default? So certainly default is one of the measures of the ability of companies to pay out their debt or liabilities. And there are various forecasts on the street. I would say majority of them are forecasting a default rate around 3% for 2024. And I think that's an indication. And the 3% is somewhat below the historical average. And again, this is an indication. The reason that we expect a default below the historical average is as an indication of the elements that I've talked about. A more conducive macro environment, a somewhat strong corporate health, and certainly the ability of companies to repay their debt is in a good place. So which leads to companies not having to or not defaulting in the current cycle, which is a positive for an investor in a high yield universe. The one point that I have to highlight here, and I think it's quite important with regards to broader dynamics and performance of high yield in 2023 and certainly in 2024 is expected to have an equal relevance, is that there's less bonds available in the market than we had before. So if you look at the broader issuance, so the expectations for high yield bond issuance has decelerated. So companies are issuing less debt, as I said. Companies are choosing other avenues to raise capital. They're going through equities, they're doing through private loans, they're selling assets. So there's just less bonds available for investors. That's one element of it. And the universe more broadly has decelerated. So if you look at in 2022, the high yield universe was around 1.8 trillion, now is more around 1.4 trillion. So there's just less bonds available for investors to deploy into. So what does it mean? The broader technicals or demand supply, it's out of balance at the moment. With the recovery of the current macroeconomic environment and with the yield seekers trying to again chase those asset classes, we're going to have less bonds now available for investors to deploy in, which provides a significant technical support. What does it mean technical? Again, the supply is lower, demand is starting to elevate or become higher, which is again compresses the spreads or compresses the spreads of the asset class, which again comes back to the are the spreads too tight at the moment, not considering where we are in the economic cycle, not considering the fundamentals that I've talked about, which are very strong, and consider the third element, the technicals in a high yield universe are quite strong, where there's less bonds available for the investors to deploy into. In terms of other elements to consider, and I think this is quite important ultimately, how would investors, if you're looking at, say, the question would be, is this a plain sailing environment in terms of the high yield universe, considering that we're going into a decelerating growth environment? So the ultimate question as well, and this is comes down to, I would say, active versus passive. We're still not in an environment where passive allocations is in a spotlight, because we do think that this is an environment that has a two-way risk, where this security selection becomes very central and very important, Despite the fact that we expect default rates to be quite low for 2024, the security selection stays the center for 2024, considering that we have a deceleration in growth, we've set susceptibility to weakness in some of the corporate sectors and some of companies, and certainly security selection and choosing the companies that have stronger balance sheets, strong cash flow generation, those companies that are repaying their debt and putting themselves in a better, more resilient state, certainly expected to perform better. So again, certainly as an active security selection environment versus a broader beta market. In terms of the dynamics of high yield, and this is again for people to forget, I would say the investors have a very short memory when it comes to returns, you know, particularly if you look at certainly positive returns, they forget how good certain assets are doing over history, and suddenly they get quite upset and suddenly leaves a scar when it comes to negative returns. And certainly the negative returns that we've seen in 2022 certainly have left quite a big scar to the investors with regards to high yield asset class. But if you look on aggregate, and you've seen the various charts around performance of high yield over time, and suddenly this is broken down by year, there's very few years in history, over the 40-year history, that high yield has provided negative returns. So again, the question is, how big returns do I want for 2024? Or the question is, will the high yield be in a positive territory for 2024? And certainly the probability for high yield being in a positive trajectory for 2024 is almost certain. Of course, the magnitude of that is dependent on various dynamics that I've just talked about. But again, not to forget that high yield only underperform in periods of significant distress. So we're not in a scenario where we're seeing any financial or economic distress. And again, considering our central scenario of non-recessionary environment for the US, so that in absence of a distress, in absence of sector distress or economic distress, the high yield, there's no reasons why the 8% that high yield is generating will provide positive return for 2024 in a high yield asset class. One other point also to highlight is with regards to spreads, and I think the big question that investors are asking is, well, the spreads are quite tight. What is the explanation of that around that? And is this the right time to invest in high yield? And the answer is, you have to compose it from the elements that I've talked about, around the macro environment that I've talked about, the fundamentals which are still constructive, and one other element, the technicals as well, that play an element. And the third element to consider is that the quality of the high yield universe has improved significantly over time. So 35% of the high yield universe, now it's a B, rated, versus the lower rated portion of the high yield market is a much smaller portion versus what it was in history. If you look at the loan market, that's a very different trajectory. So certainly the high yield market, combination of positive conducive macro, strong fundamentals still, strong technicals, but also an improved market, an improved overall universe where the lower rated securities is much smaller. And as you know, when it comes to spread, the low part of the rating is the one that drives the biggest spread. So if you account for the fact that the universe now is better rated, the spread naturally is expected to be much more narrow than history. So again, it is not, the high yield spreads are not tight versus history, they're fair, and they're particularly fair considering the environment we're in, and also they're fair considering the universe, or the universe that we're dealing at the moment versus where it was in the history. This is kind of a good slide to end in. I think the big question, as I said, for investors is, where do I deploy in 2024? What is my chances to generate positive return for 2024? And certainly, as I said in the earlier macro session, when you compare fixed income asset class, particularly the high yield versus equities, purely on the income generation, on the yield that you can generate in 2024, the high yield is unbeatable. So if you compare it to US equities yields versus high yield yield they can generate at the moment, the difference is about 5%. So you're generating 5% more in yield terms in high yield versus equities. Yes, of course, there's an element of capital appreciation, which is driving equity returns versus a high yield where capital is expected to have less contribution to the broader return, and when we have a bigger contribution when we have a turn in the cycle. But if you compare it on yield-to-yield basis, high yield is unbeatable in the current environment, of course, and of course they have the potential upside, as would equity have, when we have an improvement in the macroeconomic environment. And one point to also remember that as we move through the cycle, until the monetary policy is on the trajectory of cutting, we're still going to see two-way volatility. The macro environment is still going to provide volatility, particularly in equity, which we need to be accounted for. So, but as I said, if you look at the performance of high-yield asset class since the beginning of the year, that stayed quite resilient, stayed quite benign, which indicates that the income portion of the high-yield market is providing a cushion, is providing that resilience, is providing that low volatility relative to equities. So again, it does, the framework that I've talked about, the macro, the fundamentals, the technicals, the broader universe being better quality, selling positions high yield into a good spotlight for 2024. And I'm done with this, yeah?
Oh, you're done with this? Okay. Thank you very much, Ms. Ekaterina, for giving very insightful information about the high yield market. ขอสรุปนิดนึงนะครับจากที่ดูสไลด์ของ high yield มานะครับผมว่าประเด็นแรกเนี่ยก็คือตลาด high yield ตอนนี้มันถือเป็นตราสารหนี้ที่ให้ผลตอบแทนค่อนข้างสูงนะครับปัจจุบันเนี่ยมากกว่า 7% ก็ถือเป็น carry ในการถือตราสารหนี้ที่ค่อนข้างดีนะครับแล้วก็เรื่องที่2เนี่ยแนวโน้มนโยบายการเงินของธนาคารกลางต่างๆทั่วโลกเนี่ยก็มีแนวโน้มที่จะผ่อนคลายลงก็อาจจะทำให้อนาคตเนี่ยเรทของ high yield เนี่ยคูปองของมันเนี่ยอาจจะลดลงต่ำกว่า 7% ซึ่งการที่เราล็อกเรทไว้ตอนนี้ที่ 7% เนี่ยก็ถือเป็นเรทที่น่าสนใจแล้วก็เวลาอัตราดอกเบี้ยมันปรับตัวลดลงเนี่ยรวมถึง yield เนี่ยมันก็จะเป็นผลบวกต่อราคาตราสารหนี้ด้วยนะครับก็ถือเป็นประเด็นที่น่าสนใจประเด็นที่2แล้วก็อีกสไลด์หนึ่งก็จะเป็นเรื่องฐานะการเงินของผู้ออกตราสารหนี้ high yield โดยรวมนะครับผมว่าตอนนี้ก็ถือว่ามีฐานะที่แข็งแกร่งขึ้นถ้าเทียบกับช่วงโควิดช่วงนี้เนี่ยเขามีการ leverage ที่ลดลงนะครับโดยถ้าเราดูจากปริมาณภาระหนี้โดยรวมของบริษัทเนี่ยเทียบกับกระแสเงินสดเนี่ยตอนนี้ถือว่าอยู่ในระดับที่ค่อนข้างต่ำนะครับก็คือว่าอยู่ที่4เท่าก็คือว่ากระแสเงินสดจากการทำธุรกิจของเขาเนี่ย4 ปีสามารถชำระหนี้ได้แล้วก็ถือว่าเป็นฐานะการเงินที่แข็งแกร่งนะครับแล้วก็ถ้าเทียบกระแสเงินสดจากธุรกิจของเขา yes the debt to EBITDA and แล้วก็ถ้าเทียบกับระดับกระแสเงินสดเทียบกับภาระดอกเบี้ยก็คือกราฟด้านขวาเนี่ยผมก็มองว่าเขาถือว่ามีกระแสเงินสดที่ค่อนข้างเพียงพอในการชำระดอกเบี้ยจากการทำธุรกิจก็เลยคิดว่าน่าจะเป็นประเด็นที่น่าสนใจคร่าวๆสำหรับตลาด high yield หลังจากนี้นะครับไม่ทราบว่าทางท่านนักลงทุนท่านใดมีคำถามเพิ่มเติมในส่วนนี้ไหมครับเชิญครับ
I do know that you are focusing on the US high yield in particular. Do you have any view on the Asian high yield?
Well, I mean, I can. This certainly the strategy here is for U.S. high yield. For Asia high yield, the biggest driver at the moment is China property, as you know. So for dollar, particularly dollar high yield, close to 70% of the dollar bonds have defaulted and restructured. So it is still a tail risk and quite challenged with regards to the high yield universe in Asia, and I think this is all dependent on how China deals with the China property risk at the moment and the ability for some of the developers to restructure, refinance, and be able to pull themselves out of the current state. So I would say in a broader spectrum of high yield, when you look at US, European, and Asia at the moment we're less constructive or least constructive versus the broader, again, very constructive on both European and US high yield. Asia is, again, challenged and very much driven by what China does on China property.
Do you think the price of the Asian high yield has been too much discounted already?
Not for what it is, as I said, on dollar bonds, and again, the dollar bonds, 70% of the issuers are in distress of some nature, either defaulting or about to default or restructured. So not accounting for what the state of the universe is, and at the moment with a no clear trajectory of what the potential solution is to resolve that. So again, over longer term, as we see a more conducive, a more constructive way of resolving that property, but of course it's a longer term story potentially. but it's a big question of how it's being dealt with, how we're removing that risk. So I would say if you were to look to generate returns and harness income, the US high yield, European high yield is in a better position. Asia high yield is more of a tactical allocation if you do believe in the ability of the government to turn the property sector around and for the companies to be able to restructure successfully.
Anyone? Yeah.
Given the structural improvement in the high yield policy space, do you expect the high yield spread to tighten even further down the road?
I would say so. So not significantly from here. So I would say skew towards tightening versus widening, accounting for the fact that I've just talked about, and I would say the sell side and the market participants are more leaning towards that narrative. Versus if you say at the end of 2023 and mid-2023 when it was still uncertain around the trajectory of growth. But now as the way the central scenario is developing with US managing to engineer the slow growth but not recessionary fundamentals are still healthy and company rationalizing their financings in a very smart way, which indicated again ability for them to not being taxed by high funding costs. That you have the strong technicals, and not to forget that technicals play a massive role, particularly for European high yield. A large portion of performance last year was driven by strong technicals, where the demand was much higher than the supply of bonds. And then the broader quality of the universe. So combining all of those four, yes, the spreads have more kind of leaning towards slightly more tighter than wider from here, but not significantly so. Again, we're not far from the fair levels of where it should be.
Has further question? If not, may I? Maybe just one or two more questions about the investment process in the AXA investment asset management. As far as BBLAM has invested in one fund of the high yield fund from AXA, I think the performance is one thing, is quite outstanding. But other thing is that the credit quality. If we consider since the inception of the fund in the high yield fund from AXA, there are just only 5 defaults so far. It's been more than 20 years. Usually for the high yield, like you say,
it's around 300.
It's
that's correct.
3%. If 100 securities, it should have 3 defaults per year, but just 5 defaults since the inception of the fund. So I just want to ask, what's the key investment process from the team and the research team? What are their key analysis to avoid this default?
Yes. So, and I think the main part, and I ultimately come down to this portion that I talked about earlier, in terms of what is the real value in a portfolio for high yield asset class. It's the income return. So the income is the biggest driver of return for the high yield asset class. Now, the main and ultimate scope for our portfolio managers is to protect that income as much as possible, i.e. not to have the downside, the erosion of that income happening in the portfolio. So the attention is paid on eliminated potentially companies that are weak or susceptible to weakness ahead and before the weakness happens, because that's, as you know, when deterioration happens, it happens quite fast. So eliminating and staying away from companies that are potentially susceptible to weakness in any cycle, not just during a period of slowdown, but in any cycle will have generally there are defaults. So how do we do it? The company, the way we pay attention a lot on cash flow predictability. How predictable are the cash flow for the company? The sustainability of that cash flows over time. Also, how does the company use the cash flows? Do they use it for reckless type of activity or growth, continuous growth, or they rationalize between growth and repaying their debt? So being very conscious about that level of debt and leverage on the balance sheet. And I think this is the main 3 parameters that we pay attention to, and we look at the fundamental analysis on each of those companies, staying away from companies that again are susceptible to potential weakness. And not so much, we're not so focused on particular ratings. Again, it's much more about the quality of the company, the cash flow generation, the ability, the management quality, and how they manage their cash flow and the book is much, much more important for us. So preservation of that income is a key parameter for us. So protecting the downside and giving you the ability to harness that 8% without much of the downside risk.
Okay, thank you very much. Maybe one more question.
Yes.
It's the things that I would like to know. The risk across the industry, I think it is quite different. Which sector do you think is pretty strong now, and which sector do you think we have to be cautious and put less weight on the investment in the portfolio?
So if you look at the 2024, and I think the key benefit for performance of the asset class in 2024 is that there are no sectors that are particularly weak or particularly susceptible to a significant correction in 2024. Accounting again for the central scenario that I've talked about, we had periods I saw in the charts where we had oil selling off significantly, which had put pressure on high yield, where high yield is about 50% on oil sector. I would say broadly, majority of the sectors are in a good state. Of course, we account for the cyclicality at the moment, and some of the most cyclical sectors are expected to be be weaker in a weaker position relative to the less cyclical sectors. And of course, we pay attention much more to the leverage and the level of leverage that exists on the company books. But again, at the moment, we stay away from more cyclical sectors versus non-cyclical.
Thank you. One more question. Not sure if it's possible, but just want to know the outlook that right now the U.S. market, I think investors are pretty cautious on the commercial real estate sector, CRE.
Yes.
Is it still in a cautious status right now, or is it getting better?
Yeah, and CRE is not a big portion of the universe in high yield, but I think the broader question for many investors has been what is the potential risks or spillover of commercial real estate in the U.S. economy. And I think one point is that it's certainly a risk that needs to be monitored, but it's a gradual risk. What does it mean? Is that a lot of this commercial real estate have a certain leverage, or they borrowed from the banks, they borrowed from the capital market, they borrowed through maybe private credit. The only time that it's susceptible to adjustment when they need to relever, and I've talked about earlier, is when they need to refinance. That's when the biggest risk comes, whatever you have to refinance at a higher funding cost, or your asset or collateral that you put in place before has a lower value than it had, let's say 2 years ago, 3 years ago, 5 years ago. So the consideration is a gradual, again, it's not a very quick process, it's a gradual process, it needs to be monitored, but it's not something that is it's happening with a bang, but it's a gradual process where the erosion is certainly present, but it's not expected to be a systemic risk because of that element that not many or not all the CRAs will come at the same time, not all consistently have the same depreciation of assets. Again, there's a big spectrum of corporate real estate. So again, it's a gradual process, something that needs to be monitored, but it's not an element of systemic risk that we're currently accounting for.
So it's going to be just only the specific risk for some companies.
Yes, and for the local banks or the regional banks that we have in the US, and again they're non-existent. It's a bigger portion in the IG market. It's non-existent in the high yield market. So again, the high yield universe does not cater to that portion of the market. But again, as a broader risk, I think it's an element that we need to consider because of course if there's a big spillover, that will lead to a risk sell-off or a risk sentiment deterioration. But we do think it's a more gradual deterioration process versus kind of an immediate risk that needs to be accounted for.
All right, thank you very much. Anyone has further question? Okay, I think we are pretty good on this session. Thank you very much, Ms. Katerina, for its very insightful information so far. Thank you. Ladies and gentlemen, please give a big applause to Ms. Katerina.